Good afternoon, everybody. Welcome to the weekly economic update. It is Monday, August 8th, 2022. Hope everybody's having a fantastic day out there. It is a pretty nice day here in Colorado. Finally cooled off a little bit. Let's see, what's it, 78 degrees outside, which is always nice. We got a bunch of storms. Ooh, my beard's all fluffy today. Got a bunch of storms that came through here over the weekend. They call it the monsoon. But looks like a lot of folks in the Denver area got quite a bit of flooding. Not so much out here on the mountainside, but anyways, so pretty decent day in the markets here domestically. Didn't turn out nearly as well as everywhere else, but certainly a lot of green across the board, for at least from what I'm looking at. And let's go ahead and, well, before we get started, if it's your first time watching, give me a big old thumbs up. I love these big old yahoo. And give me a like, a share, a subscribe, all that good stuff, depending upon where you're watching this. I would greatly appreciate it. And, if what I'm talking about is interesting to you, or maybe there's some other topics or content you'd like me to talk about, let me know. Send me an email. Go to dsafinancialgroup.com. All my contact information is there. You can drop me a phone call, an email, book a meeting if you want. If you want to get your finances back on track, maybe now's the time to do it. Especially with the world falling apart. Now's probably a good time to get your finances straight. But hey, what do I know? I'm just a financial advisor. All right, well, let's go ahead and jump in and see how the markets did today. The Dow Jones finished, well, it looks like all these finished basically flat. The Dow Jones was up 0.09. The SP 500 closed at 32,832. The SP 500 was down 0.12, closed at 4140. NASDAQ was down 0.1, closed at 12,644. Small caps are up 0.81%, and the VIX today was up 0.66%. It's currently sitting at 2129. All right, let's move over to the other exchanges here in the Americas. Canada was up 0.25%. Brazil up 1.75, Mexico up 1.42. Hopping across the Atlantic, Germany was up 0.84, UK up 0.57, France up 0.8, the Euro Stoxx up 0.85, Netherlands up 0.71, Spain up 1.28, Italy up, losing my track here, Italy up 0.62, Switzerland up 0.39, and Portugal up 1.35%. Headed over to Russia, the MOEX was up 1.66 and the RTSI was up 1.05. Moving over to Asia, Japan was up 0.26, Australia up 0.07, New Zealand down 0.28. Headed over to China, the Shanghai was up 0.31, the SESE component up 0.27, the China A50, down 0.52, DJ Shanghai up 0.14. And the Hang Seng was down 0.77, and the Taiwan weighted came in down 0.1%. So like I said, lots of green on this screen today, lots of over 1%. But like I said, here domestically, it started out pretty good. Let me bring up the daily chart here for the Dow. You can see from where we started, looks like it was up about 300 points-ish, somewhere in that range. And then, spent the rest of the day just kind of hugging this line, just bouncing off of it. And if we flip over here to the S&P 500, let's see, they were up about just a hair under 1%. And then got down as low as about 1/3% and finished off in the red today. So not the best. But again, certainly not the end of the world by any stretch of the imagination. But we'll see what happens if this is, I didn't put any beard oil in it. That's why it's all fluffy today. So anyways, all right, well, let's jump over to the weekly economic update and read through that. Make this a little bit bigger. All right. Week on Wall Street, stocks turned in a mixed performance last week as investors struggled with headlines suggesting that the Fed was unlikely to soon ease up on its current monetary tightening policy. Again, I don't understand why anyone thinks that the Fed is going to do anything other than continue to raise rates until inflation is, they say under 2% or lower, but or at least until it starts to, come back down. There's so many people in the media and the talking heads on the TV who are just so eager to go back to, the zero rate environment, lots of quantitative easing and all the things that have created the problem we're dealing with right now. But again, hey, we live in a country where, people will argue with you that obese people can be healthy. And, it's just not the way it is. All right. The Dow Jones Industrial Average slipped 0.13%, while the S&P 500 rose 0.36. NASDAQ picked up 2.15 for the week, and internationals gained 0.23. Showing some resilience. Ahead of Friday's employment report, stocks were generally higher, highlighted by a Wednesday rally triggered by fresh earnings surprises and a better-than-expected economic report. The rally was especially notable because it occurred when multiple Fed officials said that the fight against inflation hadn't ended, perhaps throwing cold water on the idea that the Fed might pivot due to weakening economic activity and the prospect of cooling inflation. Aside from the single day of enthusiasm, markets were a bit jittery, especially as investors monitored Speaker of the House Pelosi's visit to Taiwan. Unfortunately, I think she made it back. A robust employment report on Friday reinforced the idea that the Fed would likely stay the course on monetary tightening, resulting in a mixed market for the week. The employment report. The U.S. economy added 528,000 jobs in July, doubling the consensus expectation of 258,000. The unemployment rate ticked lower, falling from 3.6 to 3.5%. Coincident with the jobs creation was strong wage growth, as average hourly earnings rose 0.5% in July and 5.2% from a year ago. Leisure and hospitality, professional business services, and healthcare led the way in reported job gains, as seen in most sectors of the economy. Even sectors such as construction, particularly vulnerable to, rising interest rates, saw job gains. The labor force participation rate moved slightly lower, slipped to 62.1%, its lowest level this year. All right, so economic data this week. On Wednesday, we have the Consumer Price Index and the ISM Services Index and factory orders. Thursday, jobless claims and the Producer Price Index. And Friday is consumer sentiment. Got just a small group of companies reporting earnings this week. Today on Monday is Dominion Energy and Tyson Foods. Tomorrow on Tuesday, we have Emerson Electric. Wednesday, Walt Disney Company. And on Thursday, Illumina. All right, well, that's everything for the weekly update. And I also have, for those of you on my email distribution, you're also getting the monthly economic update. I'm not going to read through all of it. It's pretty, it's got a lot of pages. Just going to kind of hit the highlights. For U.S. markets, stocks posted a big numbers in July, erasing some of the first half losses. Investor sentiment was lifted by receding inflation and recession worries and a better than expected start to the second quarter earnings season. The Dow Jones Industrial Average gained 6.73%, while the S&P 500 index rose 9.11 and NASDAQ led, picking up 12.35%. As far as the sector scorecard, all 11 sectors posted gains for the month, including consumer services up 3.87%, consumer discretionary up 18.44%, consumer staples was up 3.2%, financials up 7.19%, healthcare up 3.24%, industrials up 9.5%, materials up 6.15%, real estate up 1.52%, energy up 9.66%, technology up 13.45%, and utilities up 5.45%. So what are investors going to be talking about here in August? Historically, August has been positive for stocks with an average return of 0.7% for the month. August also has more positive monthly performances, 55, than negative, 39. But August is also known for unexpected national and world events that have moved the markets in unexpected ways. I mean, hold on. Does this have to do with like astrology or something? I mean, the month has really nothing. I mean, things happen when they happen. This is funny. Events that have have moved markets in unexpected ways. Events that occurred in August include the Asian currency crisis in '97, the long-term capital management collapse in 1998, the downgrade of U.S. debt in 2011. I remember that one, and China's currency crisis in 2015. During the month, the government will release a string of economic reports to give The Fed fresh insight into the economy for its late September meeting. After September, the Fed only has 2 scheduled meetings for the rest of 2022, one in early November and one mid-December. As far as world markets, overseas markets rallied following the lead of the U.S. markets. The MSCI index gained 3.74% last month, similar to U.S. markets. Major European markets overcame growing recession fears and deepening energy woes. France picked up 8.87%. Italy rose 5.71%. Germany was up 5.48%. And the U.K. tacked on 3.54%. The Pacific Rim were mostly higher, except for Hong Kong, which lost 7.79%. Australia gained 5.74%, and Japan climbed 5.34%. All right, well, that's everything there on the monthly update. Like I said, just kind of hit the highlights on that one. It is a little more dense than the regular weekly update. All right, well, let's read through today's market recap and see how things are going there. S&P 500 gives up gains. We already talked about that, as Nvidia drags down tech. The S&P 500 gave up gains Monday following a Nvidia-led slump in tech after the chipmaker cut its guidance. Nvidia Corporation fell more than 8% after the chipmaker reported second quarter revenue of $6.7 billion, well below the estimates of $8.1 billion, give or take 2%, as a challenging macroeconomic environment that is expected to continue in Q3 dented revenue in its gaming business. Quote, while bad news on the gaming front was anticipated, we see this result as somewhat worse than expected, Wedbush said, forecasting Nvidia to deliver earnings per share of 50 cents to 52 cents a share in Q2, compared with the consensus of $1.26. The chipmaker reports quarterly results on August 24th. The warning on performance from Nvidia weighed on sentiment in the broader chip sector, with Marvell Technology, Lam Research, and Taiwan Semiconductor Manufacturing among the decliners. Big Tech, meanwhile, was mostly lower, though Meta Platforms bucked the trend, rising more than 2%. Planeteer Technologies, meanwhile, slumped more than 13% after reporting an unexpected loss of 1 cent per share in the second quarter. Energy was up more than 1% to stifle losses in the broader market after oil price cut losses, shrugging off ongoing recession fears and slowing China crude imports that point to softer demand. Consumer discretionary stocks up 1%, driven by a rise in Tesla and airline stocks. Tesla added 1% to also lift consumer stocks as sentiment on electric vehicles was boosted by the new climate bill. Yay. We'll have a little more on that in a bit, which was passed over the weekend in the Senate and includes nearly $400 billion over a 10-year period to fund climate and energy-related programs, and an extension as well as improvement to existing EV tax credits. Again, I'm all for having the cleanest environment possible and taking care of your neighborhood and being a good steward of where you live, but this is not in the jurisdiction of the federal government. Again, go to Article 1, Section 8 of the Constitution. There is nowhere in there that says that the government has any authority to tax us for climate change or for electric cars or any of this crap. So it just gets under my skin. Let's see. In deal news, global blood therapeutics rallied 4% after the blood disorder drug maker accepted Pfizer's $5.4 billion or $68.50 per share in cash takeover offer. Signify Health jumped more than 11% on reports that CVS Health Corp is weighing a bid for the health services company, the Wall Street Journal reported, citing unnamed sources. So obviously that's a sure thing. In other news, investor appetite for so-called meme stocks returned as Bed Bath & Beyond and AMC Entertainment surged. I saw a lot of chatter about that on Reddit over the weekend, especially on the Wall Street Bets page. Boeing Company jumped more than 1% after the Federal Aviation Administration said Monday that the aircraft maker is expected to resume deliveries of its Dreamliners in the coming days. So, some good, some bad. It's kind of like just every day. You take the good, you take the bad, you take them both, and there you have the stocks of life. Anyways, I'm a little delirious today. All right, let's see here. Next up, oil rises nearly 2% on strong economic data, but trade choppy. Oil prices rose nearly 2% on Monday in volatile trading, bouncing off multi-month lows touched last week as positive economic data from China and the United States fed hopes for demand despite nagging fears of recession. Brent crude Futures settled up $1.73 or 1.8% at 96.65 a barrel. US WTI crude was at 90.76 a barrel, up $1.75 or 1.97%. Last week, fears that a recession could dent energy demand pushed front-month Brent prices down 13.7% to their lowest since February, but it was Brent's biggest weekly drop since April of 2020, and WTI lost 9.7%. Both contracts recouped some losses on Friday after jobs growth in the United States, the world's top oil consumer, unexpectedly accelerated in July. Quote, once again, macro influences have seeped back into this market, especially as it relates to Friday's employment numbers. Economics of that should be giving us much better gasoline demand than we're seeing, said John Kilduff, partner at Again Capital in New York. On Sunday, China also surprised markets with faster than expected growth exports. China, the world's top crude importer, brought in 8.79 million barrels per day of crude in July, up from a 4-year low in June, but still 9.5% less than a year earlier. Customs data showed. In Europe, Russian crude and oil exports continue to flow ahead of an impending embargo from the European Union that will take effect December 5th. So let me get this straight, or well, for everyone else out there. Russia was the bad guy and invaded Ukraine in February. It's now July or August. And Europe is going to actually, have their embargo take effect in December. Seems to really be hurting those Ruskies. Yeah, it'll never happen. Last week, the Bank of England warned of a protracted recession in Britain. In terms of U.S. production, energy firms last week cut the number of oil rigs by the most since September in its first drop in 10 weeks. Analysts at Goldman Sachs said they believe the case for higher oil prices remains strong, with the market in a larger deficit than they expected in recent months. So it doesn't look like, and for anyone who's been paying attention and watching this regularly, you know that I do harp on energy prices really being the bane of all of our problems. Energy makes the Federal Reserve is really the biggest issue, but all of the inflation that they've created has made energy more expensive, and until energy costs come back down, we're really not going to see a lot of relief everywhere else. All righty, so some potential good news. Well, I don't know if it's good news, but I guess if you're not wanting to take money out of your retirement accounts sooner than later, this may be good news. You're one step closer to being able to delay your RMDs in retirement. A bill is headed for consideration by the full Senate that would move the age at which you have to start drawing down your retirement plan to age 75. The House of Representatives passed a similar measure, so sponsors are hoping that if the whole Senate passes the bill, the proposed delay in having to start taking distributions from IRAs and similar plans will become law. Estate planning, like financial planning, can be complicated, so consider working with a financial advisor to create or update a plan. I know someone, so just let me know if you need some help. You cannot keep retirement funds in your tax-advantaged accounts indefinitely. The IRS generally requires you to start taking withdrawals, as known as required minimum distributions, or RMDs, from your IRA, simple IRA, SEP IRA, or retirement plan account when you reach age 70 and a half. If you were born before July 1st, 1949, when was this written? If you were born before July 1st, 1949, or 72 if you were born after that date. Failure to take any distributions, or if the distributions were not large enough, means you may have to pay a 50% excise tax on the amount not distributed as required. And I bet all those extra IRS agents can help out with finding that money. However, RMDs don't apply. And here's the accounts: traditional IRAs, SEP IRAs, simple IRAs, rollover IRAs, most 401ks and 403b plans, and most small business accounts. However, RMDs don't apply to Roth IRAs because these contributions to these accounts are with after-tax dollars. That said, RMDs do apply to inherited IRAs. In March, the House passed the Securing a Strong Retirement Act of 2021, dubbed the Secure Act 2.0, which included some significant changes to the U.S. retirement system. Among other things, the legislation, which passed with an overwhelmingly 414 to 5 majority, aims to replace the current age to start taking RMDs with a sliding scale that would enable anyone who turns 74 after December 31st, 2032 to delay RMDs until age 75. So wait, If you turn, okay, gotcha. This could have a profound impact on retirees' ability to save, as it would allow them to keep more money invested for an extra 18 months and defer taxes that much longer. RMDs currently kick in when a person reaches age 72. Used to be 70 and a half for most of my career. Besides delaying RMDs, the 139-page House bill includes a variety of provisions designed to help expand coverage, increase retirement savings, preserve retirement income, and simplify the rules that govern retirement plans. This bill aims to build on the Setting Every Community Up for Retirement Expansion, or SECURE Act of 2019, which included a number of reforms to help Americans save for retirement. On Wednesday, the Senate Finance Committee advanced a very similar version of the House bill with a 28-0 vote, known as the Enhancing American Retirement Now, or EARN Act. Boy, they love their acronyms that typically don't mean anything, or don't mean what they hope to mean, to the full Senate. The Senate bill raises the age at which RMDs must begin to age 75 in 2032 from the current 72. The House version takes a phased approach, raising the age to 73 in 2023, 74 in 2030, and 75 in 2033. The Senate is likely to merge its EARN Act with the Rise and Shine Act, which was approved June 14th by the Senate Health, Education, Labor, and Pensions Committee to form the Senate version SECURE 2.0. However, because there are so few legislative days left in the current session, members of the relevant Senate and House panels may work to craft a unanimous bill, part of the reconciliation process. So what comes next? The bipartisan momentum behind the move to raise the age at which RMDs have to start augurs for possible passage later this year. Still, the initiative has its critics. One criticism is that this measure basically is a gift to the financial services firms, which typically earn fees based upon assets under management. Another criticism is that it would only help the rich who have beefed up balances in their tax-advantaged accounts. Some blue-collar and working-class people are less likely to have. Still, the drive to delay the start of RMDs enjoys widespread support. Quote, "We have strong bipartisan momentum to address the anxiety and insecurity that many workers and retirees have about their ability to accumulate sufficient savings to provide them with a sustainable income during their retirement years," says Wayne Choppy, president and CEO of the Insured Retirement Institute. Lawmakers of Capitol Hill appear to be moving on a bipartisan basis toward delaying the age at which retirees must begin drawing down their savings from tax advantage plans. Both senators and representatives, as well as industry groups, appear united behind such a move. However, scheduling pressure make it unlikely to reach President Biden's desk until later this year. Or, you could sneak out of the country and just withdraw all your cash and never come back. I mean, not that I'm telling anyone to break the law, but there are ways around it. One last article here comes from our friends at First Trust. Tax hikes, bad but bearable. Yeah, remember that that bill that everyone's all excited about? Yeah, there's some tax hikes in there. Remember, I specifically remember hearing Biden say that anyone making less than $400,000 a year wouldn't see a penny, zero new taxes. Yeah, but that was a lie. With the Senate having passed a budget plan yesterday with only Democratic votes, as well as a tie broken by Vice President Harris, it's only a matter of time before President Biden signs the first significant tax hike since the, quote, fiscal cliff tax hike in early 2013. What's important to keep in mind is that it could have been worse, much, much worse. President Biden originally set out to raise the top tax rate on regular income to 39.6%. That didn't happen. Biden wanted to raise the top rate on long-term capital gains and dividends to 39.6 versus the current 20%. That didn't happen. He wanted to get rid of the step-up in basis at death. Nope. He wanted to raise the regular corporate tax rate to 28% versus the current 21%, and tax carried interest as well. Again, no dice. Well, I'm always happy when they don't get their way, at least a little bit. Compared to what the president sought, the tax hike we're soon getting is a shadow of its former self, but that doesn't mean it's good for the economy. The three most prominent sources of more government revenue will be a new 15% minimum tax on the books profits of largely publicly traded companies, beefed up IRS enforcement against the middle class. I believe it's 87,000 new agents because, we need more government parasites working for the country. And a new 1% tax on stock buybacks. Although these changes are not all by themselves going to throw the economy into recession, monetary policy eventually getting tight should generate a recession all by itself. That doesn't mean tax changes are good ideas. Take the new 15% minimum tax on companies. Essentially, Congress is outsourcing tax policy to FASB, the Financial Accounting Standards Board, which is a private organization that develops accounting standards. Meanwhile, companies that might be affected by this tax will find ways to avoid it, for example, by reorganizing, so tax deductions are taken by more profitable spinoffs that are going to pay taxes above the minimum anyhow. The 1% tax on stock buybacks is another new bizarre policy change. The theory is that companies should be using that money for business investment, not buybacks. But if a company is generating more cash flow than they effectively invest, then a buyback is better than just having money sit on the corporate treasury, where bad managers might use it for empire building, unprofitable investments, or even boost their own pay. Moreover, many of the political advocates for a buyback tax claim they want fewer companies dominating markets, but slowing buybacks means big incumbent companies have more reason to simply keep cash on their own books instead of distributing it to shareholders who can then, if they want, invest in newer startup companies. The good news is that, just like the 15% minimum tax, companies can adjust their behavior to avoid the new tax on buybacks, for example, by raising dividends. This is also why Congress is probably overestimating the revenue the new law is going to generate. Yeah, it's going to cost us a lot more than what we're going to bring in. We are also highly skeptical the federal government will hit its revenue projections for the next fiscal year and beyond. This year, there's a surge in tax revenue, a side effect of all that temporary COVID-related stimulus of 2020 and 2021, creating a feedback loop of borrowing, printing, spending, also created illusory tax receipts. As a result, the budget deficit in the past 12 months is actually slightly smaller than it was the 12 months prior to COVID. But as the economy slows and the artificial stimulus wears off, revenue growth will slow, and when recession eventually hits, could easily turn negative. The bottom line is that this budget deal will raise spending and tax rates over the next decade, and this is bad for the economy's long-term growth potential. But we've had much larger tax hikes in the past and survived. Yes, we're headed for a recession, but investors should be much more worried about how tight monetary policy needs to get, not the current tax hike. Well, thank you there, Mr. Westbury. I agree with most of what you have to say there. And yeah, spending more money is not the answer to the problems. Probably getting rid of most of the government agencies that are A, unconstitutional, and B, just are a giant tax waste. I mean, imagine if all those 2 or 3 million federal workers, if they were actually working in the private sector and were productive, as opposed to just being an anchor on the backs of those of us who pay taxes. Imagine how much wealthier our country would be. But hey, no one seems to care about libertarian and principles and Austrian economics. But anyways, all right. Well, that's everything I had for today. I've rambled enough. Hope everyone has a fantastic Monday, and I'll be back tomorrow with the Liberty Call. If anyone needs anything from me, like I said earlier, go to dsafinancialgroup.com. All my contact information is there, and if you need to book a meeting or drop me a phone call or an email, you can do it. Hope everyone has a great night, and I'll talk to you tomorrow. Bye.